Hello and welcome. If you're looking to qualify for a personal loan fast, one of the most important things to focus on is your credit score. In today's video, we'll share credit score tips and strategies to help you improve your credit and boost your personal loan approval chances. We'll explain how to improve credit in simple terms, no technical jargon, and give you actionable advice you can start using right away. By the end, you should have a clear roadmap to strengthen your credit profile quickly so you can confidently apply for that personal loan. Let's dive in. Your credit score is a three-digit summary of your credit worthiness, and lenders pay a lot of attention to it. In fact, most lenders require a minimum credit score of around 580 just to consider approving a personal loan. If your score is below that threshold, it can be very tough to get approved unless you have a cosigner or offer collateral. On the flip side, the higher your score, the better deal you'll get. Lenders typically reserve their lowest interest rates and best terms for borrowers with good to excellent credit, usually a FICO score in the 700s or above. In early 2025, the average FICO score in the US was about 715, which falls in the good range. Why do lenders care so much? Simply put, your credit score gives them a quick look at how responsibly you've handled debt in the past. A lower score signals higher risk. You might be more likely to miss payments or default, so lenders may charge you a higher interest rate to offset that risk. They might even tack on fees, like origination fees, or offer you a smaller loan amount if your score is on the lower side. In contrast, a high credit score signals that you reliably pay back what you owe, so lenders compete to offer you better rates with fewer fees. According to Bankrate's analysis, having a good or excellent credit score gives you the best chance of not only getting approved, but getting a personal loan with attractive terms. To put it in perspective, one survey found that 11% of personal loan applicants were rejected in the past year due to their credit score or credit history. That's a significant number of would-be borrowers turned away primarily because of credit issues. The takeaway, if you want your personal loan approval to go smoothly, addressing your credit score is key. In short, your credit score can make or break your personal loan application, determining not just whether you qualify but how much that loan will ultimately cost you. Credit scores in the US typically range from 300 to 850, and higher is better. Within this range, there are common categories that lenders use to judge your credit quality. Excellent. 800 to 850. This is the top tier. If you're here, you'll have no trouble getting a personal loan approval and you'll snag the lowest interest rates available. Very good. 740 to 799. A very solid score range. Lenders see you as a very low-risk borrower. You should qualify easily and get pretty favorable rates. Good. 670 to 739. This is around the average range. Remember, approximately 715 is the US average, and is usually the cutoff for what many consider good credit. With a score in this range, you have a good chance of loan approval, though not the absolute best rates. Fair. 580 to 669. This is below average. You can still get personal loans with fair credit. Many lenders' minimum is around 580, but you might pay higher interest and face more scrutiny. Poor, 300 to 579. This is a very low score. In this range, it's difficult to qualify for unsecured personal loans. You may need to improve your score or seek special bad credit loans, which often come with high costs, if you're here. FICO score 8 ranges by population. Only about 13% of Americans have a poor credit score, 300 to 579, and 16% are in the fair range, 580 to 669. On the brighter side, roughly 71% of Americans have a good FICO score, 670 plus or better, giving them a stronger chance at loan approval. Take a moment to check where you stand in these ranges. If you've never checked your credit score before, you can obtain it through many free services or your credit card issuer. It's also a good idea to pull your full credit reports from the three major bureaus: Experian, Equifax, TransUnion. You're entitled to a free credit report from each bureau every 12 months via the official site annualcreditreport.com. Reviewing your report helps you see exactly what lenders see, and it might reveal some red flags or errors that are dragging your score down. Before applying for any loan, do a thorough checkup on your credit. Obtain your credit reports, as we just mentioned, and scan them for accuracy. If you spot accounts you don't recognize, incorrect balances, or old negative items that should have fallen off, take action before you submit a loan application. Disputing credit report errors can be one of the quickest ways to gain points on your score if something wrong is pulling it down. You can dispute errors by contacting the credit bureau online or via mail. They generally have 30 days to investigate and respond. For example, if a paid-off loan is still showing as unpaid, or someone else's delinquent account got mixed into your file, getting that removed could immediately improve your creditworthiness in lenders' eyes. Not only do errors matter, but so does understanding the negative information that is accurate on your report. Do you have late payments? High credit card balances? Knowing this directs you to which tips will help you the most. And here's a pro tip. Try to address any big negatives ahead of time. If you have an account in collections, for instance, paying it off might help. Some newer scoring models ignore paid collections. Or if you had a one-off late payment, you could politely request a goodwill adjustment from the creditor to see if they'll stop reporting that late now that you're current. They might say no, but it never hurts to ask. In summary, start with a clean and informed slate. Check your credit, fix what you can, and then move on to boosting the positive aspects of your score. Improving your credit score is usually a marathon, not a sprint, but there are definitely some quick wins you can leverage. Let's go through the most effective steps one by one. 1. Pay your bills on time going forward. This sounds obvious, but it's critical. Payment history is the single biggest factor in your FICO credit score, making up about 35% of it. Lenders want to see that you consistently pay your debts as agreed. So, first things first, avoid any new late payments like the plague. If you have bills due, credit cards, utilities, anything that could end up on your credit report, pay them on schedule. Set up automatic payments or calendar reminders to ensure nothing slips through the cracks. If you're already behind on a payment, try to get current as soon as possible. A single 30-day late payment can knock many points off your score, but the sooner you get back on track, the better. Over time, recent on-time payments will begin to rebuild trust in your credit profile. And remember, if you're struggling, you can often work with creditors on a solution. For example, some credit card issuers have hardship programs or might allow you to change your due date. The bottom line, never miss a payment deadline if you can help it. It's the foundation of a good credit score. Fast fact, paying all your bills on time for a month won't launch your score into the stratosphere overnight, but it will prevent new dents in your score, and consistently paying on time will steadily improve your score. Some viewers ask, can on-time payments really improve my score quickly? The answer is yes, especially if you had any recent late payments. Bringing those accounts current and then keeping a perfect payment record for the next few months can lead to noticeable score improvements. Plus, timely payments are something lenders will see when they review your full credit history. 2. Reduce your credit card balances, credit utilization. After payment history, the amounts you owe on your accounts is the next huge factor, roughly 30% of your score. In particular, credit scoring models look at your credit utilization ratio. That is, the percentage of your available credit you're using on revolving accounts like credit cards. To calculate it, you take your credit card balances and divide by your credit limits. For example, if you have a $500 balance on a card with a $1,000 limit, that card is 50% utilized. Lower is better for this ratio. As a general rule, try to keep your utilization below 30% on each card and across all cards combined. If you can get it even lower, into the teens or single digits, that's even more beneficial. Why does this matter? Because a high balance relative to your limit can signal that you're overextended, which is risky from a lender's perspective. The good news is that paying down credit card balances can boost your score quickly. In many cases, you'll see the effect in the next monthly reporting cycle or two. In fact, by paying bills on time and using less of your available credit, some people have raised their credit score in as little as 30 days. It's one of the most effective things you can do if you need to improve your credit fast. So, if you have any savings or extra cash, consider using some to knock down those card balances. Focus on the cards that are closest to their limits. Maxed out cards hurt your score the most. Even bringing a maxed out card down to 50% or 30% of its limit can give a nice score bump. And if you have multiple cards, spreading out the debt can help too. For instance, having two cards at 30% each is better than one at 60% and one at 0%. Of course, paying them off in full is ideal for both your score and your interest costs. Quick hack. You can attack high utilization from two sides. Pay down balances, as we just talked about, and/or increase your available credit. How do you increase available credit? One way is to ask for a credit limit increase from your card issuer. If your account is in good standing, sometimes they'll raise your limit upon request, especially if your income has gone up recently. This instantly lowers your utilization percentage, because your balance is now a smaller share of a larger limit. Just don't use the new credit once you get it. The goal is to make that ratio better, not to run up more debt. Also, note that some banks may do a hard inquiry when you request a limit increase, which could ding your score a few points, so ask if it's a soft or hard pull in advance. But many will do it without a hard credit check. If approved, this can be one of the fastest ways to boost your credit score, aside from paying off debt. Finally, once you pay down your cards, try to keep them paid down. You could even make an extra mid-cycle payment before the statement cuts to reduce the reported balance. Aim to use your cards lightly, and your credit score will thank you. 3. Avoid new credit applications. Minimize hard inquiries. When you're trying to improve your credit quickly, you want to avoid doing anything that could temporarily lower it. Applying for new credit is one of those things. Each time you apply for a credit card, loan, or any financing that triggers a hard inquiry on your report, your score might dip a few points. One inquiry alone isn't usually a big deal. Often it's a drop of less than 5 points and it bounces back within a few months. But if you apply for several accounts in a short period, those small dips can add up. Multiple recent inquiries also make you look riskier to lenders. It can appear that you're desperately seeking credit. So, pause on new credit applications while you're preparing for a personal loan. Don't open a new credit card or finance a new purchase right before you apply for the loan you actually need. Also avoid the temptation of buy now, pay later plans, or any form of credit that would show up on your reports. Keeping your credit profile steady and unchanging for a couple of months can only help. Lenders like stability, and you don't want to accidentally drop your score 5 or 10 points because you couldn't resist opening a store card for a one-time discount. Now, what if you need to comparison shop for the personal loan itself? It's actually wise to shop around for the best loan rate, and you can do it without hurting your score. The trick is to use pre-qualification options whenever possible. Many banks and online lenders allow you to pre-qualify with a soft credit inquiry, which doesn't affect your score. This gives you a rate quote or at least an idea of whether you'll be approved, and you can use these quotes to compare offers. Only the lender you ultimately decide to formally apply with will then do a hard pull. By pre-qualifying with multiple lenders, which is a soft pull each time, you can shop for the best personal loan and still keep your credit score intact. If you end up needing to apply to a few different lenders to secure a loan, try to do those applications around the same time. Credit scoring models often recognize when you're rate shopping for a single loan. For example, FICO might treat multiple inquiries within a 14 to 30-day window as just one inquiry for certain types of loans. This consolidation of inquiries traditionally applies to things like mortgage and auto loans, and depending on the scoring model, it may also apply to personal loans. So grouping your applications close together can minimize the impact. But again, the ideal scenario is one hard inquiry for the loan you choose. Fourth, dispute inaccurate or negative information. We touched on this earlier, but it's worth reiterating as a tip on its own. Removing errors or unfair black marks from your credit report can give your score a quick lift. Did you find a collections account that isn't yours? Dispute it. Is a paid loan still showing as unpaid? Dispute it. The credit bureaus have online dispute forms that make it relatively straightforward. When you dispute an item, the bureau has to investigate and respond, usually within 30 days. If they find your dispute valid, or if the creditor fails to respond to verify the information, they'll correct or remove the item and your score could improve as a result. Beyond outright errors, what about negative items that are legitimate? While you generally can't dispute accurate information, you might be able to negotiate certain things. For instance, if you had a single late payment a year ago on a credit card, and since then you've been a perfect customer, you could write a polite letter to the card company asking for a goodwill removal of that late mark. They're not obligated to do it, but some creditors, especially credit unions or smaller banks, might forgive one slip-up if you've been loyal and you ask nicely. Another approach, if you have an old collection that's unpaid, you could try a pay-for-delete negotiation with the collection agency. Basically, you offer to pay it, possibly in full or part, if they agree to remove it from your credit report. Not all agencies will do this, and there are ethical debates around it, but it's a possible avenue. Note: only put this agreement in writing. Get confirmation that they'll remove it before you pay. 5. Become an authorized user on a trusted account. This is a credit-building trick that can sometimes give you a quick boost, especially if you have a thin credit file or a shorter credit history. Being an authorized user means someone, usually a family member or very close friend, adds you to their existing credit card account. You get your own card, and the account may show up on your credit report as if it were yours. The key is to do this with a responsible person's credit card, one with a long history, a high credit limit, and a low balance, and of course, a spotless payment record. If you have a parent, sibling, or spouse willing to add you, their good history can start benefiting your score. It's kind of like piggybacking on their credit habits. Now, you don't actually have to use the card, and certainly do not abuse this privilege by racking up debt on their account. In fact, you could be added and not even be given the physical card. You're just there to soak up the positive credit vibes. This can help increase your average account age and improve your utilization, since you're now associated with a high credit limit that maybe has little or no balance. And of course, their on-time payment history on that card will reflect well on you too. A word of caution: choose the right person and account. If the primary cardholder maxes out the card or misses a payment, that negative information will likely hit your credit report as well, which is the opposite of what you want. So only do this with someone who is extremely reliable financially. Also, not every lender counts authorized user accounts heavily in scoring, but many do, and at the very least, it can't hurt if done correctly. It's a fast way to potentially boost your credit score without any new debt or long waiting period. Some people see their score rise within a month or two of being added as an authorized user, especially if that card was a strong positive line. 6. Keep old accounts open. Don't close your credit cards. When trying to improve your credit, you might think closing credit card accounts you're not using is a good idea, maybe to simplify things or remove temptation. But from a credit score perspective, closing accounts can actually hurt you, particularly if it's an older account. Remember the credit utilization we talked about? If you close a credit card, you lose that card's credit limit in your overall utilization calculation, so your overall utilization ratio could jump up. For example, if you have two cards each with a $1,000 limit, total $2,000, and you owe $500 on one card, you're at 25% utilization overall. If you close the other card that had no balance, suddenly you only have 1,000 total limit and you still owe 500, boom, you're at 50% utilization, which could drop your score. Additionally, the length of your credit history, especially the average age of accounts, is a factor in your score. Closing your oldest card can shorten your apparent credit history, which might ding your score over time. So, unless there's a compelling reason, avoid closing credit accounts while you're improving your credit. If an old card has an annual fee you can't justify, you could see if the issuer will downgrade it to a no annual fee version rather than closing it. If you're worried about an account being closed for inactivity, just use it once every few months for a small purchase, like a tank of gas or a grocery run, and pay it off. That keeps the account active and contributes positively to your score by adding to your available credit and lengthening your credit history. In short, cherish your long-standing accounts. They quietly boost your creditworthiness just by existing. 7. Consider a secured credit card or credit builder loan if you need to build credit. This tip is more about building or rebuilding credit within a few months, and it may not be applicable to everyone. If your credit score is low, partly because you don't have much credit history or you have very few accounts, adding a new trade line could help. The catch-22 is that it's hard to get approved for new credit when your score is low. That's where secured credit cards or credit builder loans come in. A secured credit card is a type of credit card where you put down a refundable security deposit, say $200 or $500, and that deposit becomes your credit limit. Because you're securing it with your own money, these cards are much easier to get, even with bad credit, and they report to the credit bureaus just like a normal credit card. By using a secured card responsibly, small purchases, pay in full each month, you can start generating positive credit history. Over a span of a few months, you may see your score improve as a result of those on-time payments and the additional available credit. Many people use secured cards as a stepping stone. After 6 to 12 months of good use, you might graduate to an unsecured card and get your deposit back. While your credit score is a major factor in qualifying for a personal loan, it's not the only thing lenders look at. To wrap up, here are a few extra pointers to strengthen your loan application and improve your approval chances, especially if you're in a hurry. Manage your debt-to-income ratio. Lenders also pay attention to your debt-to-income (DTI) ratio, which is the percentage of your monthly income that goes toward debt payments. Even with a great credit score, a very high DTI can make lenders hesitant. If you can, try to pay down some existing debt before applying. For example, paying off a small car loan or credit card could free up room in your budget. Or if there's an opportunity to increase your income, maybe a side hustle or asking for a raise, before you apply, that helps too. A lower DTI means you have more disposable income to cover a new loan payment, and that can lead to a quicker yes from a lender. Some lenders will approve loans with DTI up to 40 to 50%, but lower is always better. Apply for a realistic loan amount. You might be tempted to borrow a larger sum, but asking for more money increases the risk from the lender's perspective. If you want to get approved quickly and easily, consider requesting a smaller loan amount if that can meet your needs. Lenders are more comfortable lending smaller amounts, especially if your credit is on the borderline. Borrow only what you need. You can always refinance later or take another loan when your situation improves. As Bankrate notes, the less you borrow, the less risk the lender sees, which can make approval faster and more likely. Even if you have good credit, a conservative loan request can sail through underwriting with fewer hiccups. Consider a co-signer or co-applicant. If your own credit score still isn't where you want it to be and you need the loan sooner rather than later, adding a creditworthy co-signer can be a game changer. A co-signer, like a parent, spouse, or close friend with good credit, essentially vouches for you. They agree to be responsible for the loan if you don't pay. This reduces the risk for the lender and can lead to an approval that you might not get on your own. Many lenders allow co-signers on personal loans. Just be sure that both you and your co-signer understand the responsibility involved. If you miss payments, both of your credit scores will suffer and your relationship could be strained. But used judiciously, this can be a quick ticket to loan approval. Fun fact, some lenders even count a co-applicant's income in the application, which can help if your DTI was a bit high. Choose the right lender. Different lenders have different credit criteria. Big banks might have higher credit score cutoffs, whereas credit unions or online fintech lenders might be more flexible or willing to work with fair credit borrowers. Credit unions in particular often look at your whole financial picture and not just your credit score. Plus, they tend to offer lower rates. Federal credit unions cap interest at 18% by law for most loans. If time is of the essence, do a bit of research on which lenders cater to your credit range. Sometimes going with a lender that specializes in personal loans for fair credit or similar can save you from a rejection and wasted inquiries. In any case, try the pre-qualification step we discussed to gauge which lender is giving you the best chance. By combining these approaches with the credit score improvements we went over, you'll put yourself in the best possible position to get a fast personal loan approval. Improving your credit score quickly is definitely achievable with the right game plan. Let's recap the most important credit score tips we discussed. Know where you stand, check your credit score and reports early. Fix any errors and understand what factors might be holding your score down. Pay on time, every time. This is non-negotiable. Set up systems to never miss a payment, as it's the #1 factor in your score. Pay down your debts, especially credit cards. High balances relative to your limits can significantly drag your score down, but reducing those balances can boost your score in a matter of weeks. Aim for that magic under 30% utilization mark, or lower. Avoid new credit and hard inquiries. Don't let unnecessary credit applications sap the points you've been working to gain. Use soft pull prequels to shop around, and only apply for credit you truly need. Build smartly if needed. Consider tools like becoming an authorized user on a responsible person's card, or using a secured card to build positive history. And keep those older accounts open to lengthen your credit age. Be strategic with your loan application. Once your credit is in better shape, strengthen the rest of your application. Keep your requested loan reasonable, and don't hesitate to leverage a co-signer if that makes the difference in getting approved. Thank you for joining us today and investing time in your financial well-being. If you found these tips helpful, feel free to hit the like button and subscribe for more insights on personal finance. We share lots of advice on loans, credit, and money management. Best of luck with your personal loan application, and remember, with the right approach, you can qualify for that personal loan faster and save money in the process. Good luck and take care.